Thank you. Thank you. Welcome, everybody. Fantastic snowy day down here in Utah County. Thank you for joining us. I would like to introduce myself for those of you who may be new. I am Johnny Christensen. I am the Regional Director for Keller Williams for the state of Utah. And behind the curtains, my main man, Gordon Payne. I want to thank him and do a huge shout out in preparation for this. Thank you for being here. I'm super excited about this. So thanks for jumping on. Let me hurry and share my screen and we'll get rocking and rolling. So has the real estate market been crazy or what? Definitely a lot of changes. So we have quite a bit of information to roll through. As always, you can find these reports on kidabutah.com, but this is hot off the presses. We have been pulling data from 50, 60 sources. We're hopefully becoming the Pivotable Market Report on a quarterly basis now. I know most of you have joined us in the past on our market reports, but those of you who are new, we've got a lot of different data to go through. So super excited about this.
And I'll be posting this later this afternoon along with the video.
Great. Awesome. Well, thank you. And Gordon Novalee and my assistant Jace will be monitoring the chat if any questions can be answered there. But if I need to be interrupted as we go through this, just to clarify a few things. But Gordon has prepared about 115 super slides of data. So we got quite a bit of stuff to go through. I'm assuming we'll have somewhere around 150, 200 people join us today. So they keep rolling on. But welcome Keller Williams agents, partners of Keller Williams. I know we have a bunch of guests that are jumping on, as well as I've heard of family members that are starting to join us to get as close to the market as possible. So let's kick it off. Thank you for being here. But here is our summary. Here's our summary of a snapshot of the Utah real estate market. So you can see on the right column over here, primarily we have year-to-date 2022, and then you're comparing it to year-to-date 2021. So new listings were basically flatlined the entire year. Pending sales were down. So pending sales as you're under contracts down 24.5%. This no doubt is probably why you're here. We've all felt a little bit of shift. We're down 20.6% in the year of 2022 in our closed sales. Days on market slightly trickling up. We'll show you a lot of month over month slides. Median sales price just continued to blow me away, but even 2022, we ended at up 15.1%. The median home price across the state of Utah officially over $510,000. So crazy. I got into the real estate business at 2007. And I just remember those $200,000, $250,000 purchase prices. So much back then, but 510, crazy. Original percent of original list price when a home gets listed, what it actually ends up selling for is continued to come down the last couple months. Officially ended at 99.1% of homes sold for what their original list price was. And affordability, which is going to be the story and the theme of our market report. No doubt affordability continues to be one of the bigger challenges with interest rates having gone up, our purchase price having gone up. But homes for sale, it's about time we had a little bit of inventory. Our agents have been running around crazy the last couple of years, but we ended up with 101,000 homes for sale on the market, up 79.7%, which again, month supply on average throughout the whole year, 2.1, but you'll see kind of how we've been trending the last quarter. But look at December even. December, it definitely felt a little chaotic, but we were down. This is month over month. So December of last year of 2022 compared to December of 2021, felt like we stalled a little bit, but we were down closed sales 44.9%, just comparing those Decembers. But we'll dive into that a little bit. So again, we're going to hit a few different big sections of this market report. We start out going through the numbers that drive the U.S. real estate market. So we talk about home sales, home prices, months of inventory, mortgage rates, affordability. And again, if this is your first time joining us, we go back and forth between looking at the United States real estate market, and then we compare it to the Utah real estate market. And we used to pace sometimes behind the U.S. market, but we've been pacing ahead in quite a few categories. So you'll see that. Gordon has also added a great investment section. I know many of our agents are also investors. We'll talk about rents and kind of what the investment market's doing. We hit construction market and a handful of other just general economy type of categories. So let's look at U.S. home sales. The U.S. home sales, we ended the year officially at 5.1 million homes sold across the country, comparing that to 2021 of 6.1 million. And these are homes sold, and typically there's a buy and a sell side of every transaction. So you can assume there was about 10.2 sides, 10.2 million sides. We haven't hit below that 5.1 mark since basically the 2013, 14-ish market time. So we kind of went backwards a decade to some of those numbers. But the real story is the month over month. So you got orange, which is 2020. You got purple, which is, or is that a magenta, Gordon? 2021, 2022 is the light blue. But let's look at that light blue. So this is a rolling 12-month number. So January of 2022, the 12 months preceding that, we were at 6.5 million homes sold in the country. Very healthy number of homes sold. I think we were all still very busy, no doubt, but just every single month, we've basically seen a decrease in the rolling 12 months. So we were at 6 million in February, 5.7 million March, 5.6 April, 5.4 million in May, 5.1, then 4.8, 4.8, 4.7, 4.4, 4, and 4. So when we ended December, we were on that rolling trajectory. So definitely have felt that. No doubt our training rooms are filling up. We have moved from a speed-based market to a skill set-based market. And hopefully you guys are working on your skill set and spending more of your time lead generating. But let's compare that to Utah, our annual home sales by year. 2022, we ended the year again at 44,602 closed transactions in the state of Utah. About 11,000 homes sold dropped from 2021, which again, we basically reverted back to somewhere around those 2013-14 home sold numbers. But again, here's the story of home sales on a monthly basis. So you can see January 2022, we were at 3,000 homes sold, 32. You can really see some seasonality come into this, let alone when we talk about listings coming on the market. No doubt it's easier to see the seasonality when we look at the Utah numbers sometimes versus the United States numbers. But just look at October, November, and December. No doubt winter tends to be slightly slower than the summertime, but December 2,644 homes sold. So home price, let's talk about home price. So this is US home prices by thousand. So we ended the year 2022 across the United States at $383,000 median home price in the country. And if you're not familiar with what this yellow trend line is, typically a very stable, consistent appreciation of home price should kind of stay along that trend line of 4% appreciation a year. A lot of economists, even Gary Keller, talks about that as a very sustainable appreciation number every single year. Clearly, that early 2000s, we went above that trend line quite a bit for several years. And again, when the market and we hit that Great Recession and the market kind of crashed, we fell drastically underneath that 4% trend line. I remember
show and sell.
Below that trend line, we fell quite a bit. And I remember being at Family Reunion with Gary Keller saying, Jay Papasan saying that there is a chance we may never return back up to that trend line. And there was a little bit of rumors that we might even actually not pace back and we might reset that trend line. But clearly 2021, 2022 was quite a bit different. Look at that giant jump there in 2021 and 2022. So we're above the trend line. We know that, and most likely we're going to see some price decreases that might return us there. But here's an overlay of interest rate over that median sales price. So you can see that trend line of interest rate. We just no doubt were blessed with 2% and 3% interest rates, mortgage interest rates for so long. And just no doubt the Fed raised their Fed rate and it kind of drove those things up. But look at price on a month-to-month basis. The United States actually peaked in June of 2022 at 416,000 median price. And we've actually drastically dropped already down to that 367,000 number. But then again, rates no doubt peaked in October, November. We saw a little bit of slide backwards down to 6.4% in December. But here's the story. When price go up, interest rates go up. 2021, this is the US median home payment. This is principal interest, median purchase price, median interest rate. This is what your principal and interest payment would be with a 20% down payment, was $1,170 in 2021. 2022, with the rise of appreciation of homes and interest rates combined, look how far and drastic we jumped, right? And I know you felt this working with your buyers and getting them pre-approved and affordability issues and potentially sitting on the fence. But that's one of the major challenges, is when you have prices go up and interest rates at the same time, it creates quite a big gap. And Utah, we have no doubt appreciated quite a bit. So we actually didn't go too far above the trend line, nor below the trend line in that Great Recession. So we always felt like we were a little bit more of a conservative, pretty solid economy. But with the net positive migration, people moving here, you know, a lot of the economic boom that we've had, and even just the lack of housing being underbuilt, our price has just gone up faster and bigger than the United States median price. So we ended 2022 at that $510,000 price, which look how, you know, using the same algorithm on that trend line, look how far above that trend line on that long-term average 4% is. This is consistently one of the big things that Gordon and I talk about when we review all this data, of just one of the bigger challenges being affordability, right? So let's look at that same data with the overlay of interest rate and that median sales price. Again, we peaked in the country in June. We actually peaked about a month or two before, just in April and May, and we've seen a slide down where we ended December at 477,000 median price. So no doubt we've already started seeing those prices come down. But when you look at how fast we went up the first handful of months of 2022, and including the decrease, it still felt kind of like a flatline year on appreciation in some of the parts of the state. But still, no doubt we are trending backwards, downward depreciation as far as home prices go. But here's the real story in the state of Utah. So you saw about a $600 a month increase in the payment in the United States. Look how drastic that is in the state of Utah. Last year, our median home payment, 20% down, which is basically a median mortgage rate on the median purchase price with 20% down. Last year, our payment with those 3.1% average mortgage rates was $1,537. And then look how that has shot up as we've continued to appreciate the early parts of the year of 2022. And then also mortgage rates, we're up to $2,832 for a median home payment. Almost as expensive as Gordon's Ferrari payment, but still very expensive, and that continues to be one of the bigger challenges. So I would probably say when it comes to buyers, sellers, clients, consumers, the number one question they ask me, and I'm assuming that's the same question you get, is what is home prices going to do this year in 2023? Which it is always just a kind of a shot in the dark. We try to do as much education and gather this data to give our projections. But here's an article that came out several weeks ago. Basically, these are the 27 leading research firms that have economic departments that try to project what home prices are going to do. These are their projections for home prices in 2023. And look at this discrepancy. We have people all the way down to Realtor.com that thinks 2023 home prices are going to go up 5.4%. And we have several that think it could go as far down, depreciation as far and low as 20% backwards in pricing, which again kind of shows you that nobody really knows what the answer is. But, you know, I would probably say if you averaged all those out, you could probably guess who's doing pretty well on average projections. Keller Williams right there, Ruben Gomez, who is one of the leaders in our economic department. He was the one quoted in this. Keller Williams is anticipating probably about a 10% depreciation in home prices on average across the country. And Gordon, when I look at the data that we're looking at with home prices already trending backwards, I know that we're going to see inflation data in a little bit, but I do have a hard time thinking that appreciation in 2023 is possible. Even if we really got inflation back fast, the economy started recovering pretty quick, it's hard to think that we're going to appreciate, but you still never know. But the challenge is look at the most optimistic people on their projections. NAR, the National Association of Realtors, Realtor.com, which the Realtor Association does not own anymore, but they're projecting 5.4%.
Yeah, and it's hard to also believe that we're going to have this drastic crash that everybody keeps putting on YouTube, because in a few slides from now, you're going to see how far we've underbuilt for the last decade as well.
Yeah, the lack of construction. We're going to see a lot of that data of how underbuilt we are. That is no doubt a underlying compelling reason that this is different from the Great Recession, no doubt. And, you know, I do think we'll be able to move that inflation number. Hopefully we start seeing a reprieve on mortgage rates in the year of 2023. But yes, appreciation still, in my opinion, seems unlikely. So let's again just compare those two with where we start separating from the pack of the United States. Again, early 2000s, you can see Utah was actually under the median price in the United States. We crossed over right there around 2007, primarily because Johnny got in the business and prices just started cruising up. Just kidding. And basically we started tracking with them all the way until what, 2016-ish, you see that separation. But 2020, 2021, 2022, you see that separation be really clear how big of a gap and prices going up. Are we the new California? I don't think so, but you could see why people say that. So here is on a year by year US home prices annual appreciation. So you can see last year still, even though we start going backwards, the increase in appreciation early in 2022 still outweighed. And we ended up at a 9.4% appreciation over the whole country. 2021, no doubt, was the story of the century of 17% median home price. Anybody that bought real estate in 2020, 2019, and just held it for the last 3 years, no doubt, we're happy with the equity showing up on their balance sheet. But again, even some of these years, the middle teens, you know, 2013, 14, that's a little higher, but that still felt somewhat sustainable. It's really the last 3 years that have caused the majority of our affordability issues. And then here's Utah's home appreciation on a yearly basis. 2022 still ended up 13% appreciation. 2021, 25% appreciation. Crazy number right there. 11.6% appreciation, 7.7, and then 10.7. I ended up adding these up last night. Basically, the Utah real estate market appreciated about 25% more than the United States over the last 5 years, which still had a little bit of a compound effect when you do that on over a 5-year period of time. Inventory, again, we'll see the month-to-month slides, but inventory on average in the United States trickled up a little bit on average for 2022 at 2.6 months of inventory. Most of you guys and gals know this, but a balanced market is still considered around that 6 month of inventory mark. And basically the way you calculate this, if no more listings came on the market, how many months would it take to sell the existing supply of inventory out? And you can see the last time we actually truly were considered in a buyer's market was 2011. And you'll see a lot of these listing numbers coming up, but just still no doubt in a seller's market. But here's your month over month numbers, which tells a little bit more of the story. We started the year at 1.6 months of inventory and we ended at 3.4 months. So a full 2 months increase of US inventory. But even just, you could see 2021, we start trending down on that purple line, which created quite a bit of havoc with our buyers agents and the speed at which it took to pre-approve someone, write offers, cash offers, all the different things that our agents were doing to make their buyer offers competitive. Here's another way of looking at it. They call this, you'll see a lot of index formulas that have to do with the 100 index. So basically that dotted line at 100, anything above the 100 is considered an expanding market, an expanding home sales market. If you fall below that 100 number, that is the opposite. So you're decreasing the expansion of the housing market. But on a month-to-month number, you can see we dropped all the way down United States-wise, 79, 77, 73, 76. And then here you can see U.S. new single-family housing units completed. So this is in the thousands. The 53-year average of single family housing units completed on the bottom, you can see is right there around 1.2 million homes completed. For the last 15 years, basically, we have been below that 53-year average trend line. So again, the theories are if you add up a bunch of those numbers, we still continue to be somewhere around 5, 6 million, 5, 6, 7 million potentially homes underbuilt in the country. And again, even kind of my theory of what's going on, I know builders are starting to slow down. You got some buyers sitting on the fence. I know the affordability is a challenge, but again, we're still not solving the underlying issue of how many homes underbuilt we are. And again, the complexities of building a home, the challenges that our builders are having is, land prices, labor prices, construction supply prices, even trying to balance that with, volatile home prices the last 12 months. But here's on a month to month basis, you can kind of see, for the most part, 2022 was somewhat consistent right around that million-ish number of homes built on a rolling 12-month number. And here's the US showing index. Okay, so this is basically tracking showings scheduled on homes. I really, really like this, but here is a higher number. I'll read this description. A higher number means an average home receives more buyer visits in a given month. All index values are scales relative to initial index at 100, which started January 2014. So the yellow line is your year over year. Are we trending with more showings on an average home? Or are we trending down? You could see we've been trending low, finishing even December down 32% on the showing index. And then the actual purple is that bar graph of the showing index. So we finished at 117, which is still above that 2014 index set of 100. And then here's your annual months of inventory. So let's look at Utah now and how our inventory has been doing consistently over the last several years. We've been under the United States inventory numbers, which means we've had less inventory, which has created even more challenges for our local Utah agents. But look at the month-to-month numbers. So that's where we, no doubt, we're pacing somewhat similar to the United States. We started out below 1 month of inventory. You agents know that it was crazy, right? Stuff was flying off the shelves. You guys may not believe this, but I saw a listing pop on the market a week ago. I looked this morning and that listing is still there a week later. Crazy, right? But no doubt you see over the last several months, we've also popped up to the threes, 3.1, 3.3, 3.2, but we did drop a little bit more in December down to 2.8. But I also think that was maybe because there was a little less listings coming on. So we caught up bringing that number down a little bit. But again, listings on a year over year basis, we were sort of flatline, maybe about 1,500, 1,500 less listings came on the market in 2022 than 2021. You could see the peak 2018-19, we were really close to 70,000 new listings coming onto the market in those years. But then here is our month over month. So you can see in the summertime, you see that seasonality. So get ready for more listings coming on the market. March, April, May, all fantastic months to just be a momentum with your habits, your lead gen time, your listing presentation, honed in. But you can see we've kind of been through the worst typical average months of listings coming on the market, November, December, those holiday months. But last December, just barely 2,241 listings came on, which again is the lowest number of listings that came on the market in the last 3 years. Which again, potentially is why we saw the supply slightly drop because less listings came on. So we ate into that inventory number a little bit more. So here is a percent of new residential listings sold. This is on a month-to-month number. So sometimes if we sell more listings in a month than came on, you're going to be above that 100% number. But basically, we sold just a little bit more listings than came on the market. But then you can see a lot of that happens in December. So December, usually less listings come on. People don't want to have their home on the market for the holidays, but we're still selling houses. So that's why you see that number be a little out of the ordinary. But traditionally we're somewhere around that, 50, 70, 80% number of homes sold based on new listings coming on. But here's really, you could see the trend of it on this bar graph over the last 3 years. Again, so 104% in December, but much lower traditionally than those other couple years that we've been tracking. But here is total homes for sale. Total homes for sale. Again, we've been floating around that 10,000 at any point, 10,000 active listings that are homes for sale in the state of Utah. 9,674 is what we averaged in the month of December. You could see clearly you were all tracking this. We got, I think, sub 3,000 listings a little bit of those months earlier this year. But again, it still remotely feels like base camp at Mount Everest back there in the recession time period. The number of vacant homes and bank-owned homes and foreclosed homes and short sales, still a fraction. We peaked right there in July, June of 2008 at 33,609 active listings on the market in any given moment. Crazy. I remember sending a list of properties, 40, 50 properties to my buyers. They would weed through it. They'd pick their 20. We would schedule appointments a full week later to go see 10, 20 of those homes. And every single one of those homes was still available. The amount of inventory that was available for buyers back then was just extraordinary, no doubt. Which again, that is a very extreme buyer's market. And we just came out of a very extreme seller's market. So again, somewhere around that 10 to 20,000, probably even 15,000 homes for sale at any moment, probably is just really middle of the ground, kind of perfect balance between those two markets. But here is your homes for sale on a bar graph zoomed up on the last 3 years. Again, you look right there earlier this year, we were sub 3,000, 2,868, 2,778. Those January and February, just crazy times for our agents, but we're back up to that 10,000, 11, 12,000 in the last several months. So here is a percentage year over year. So you can just see we're up almost 80% more homes for sale this year than we were last year. You could see those 2 consecutive years, we just continue to decrease the amount of homes that were available for sale. Here's pending sales. So this is basically when a home goes under contract, it's considered pending. Just that really was quite a drop. We ended up at 56,000 in 2021. And then 2022, 40,866. Okay, and then here's on a month to month. Again, we under contracts the last 3 months has been pretty low. 2,416, 2,321, 2,105. But no doubt that's what correlates with the drop in closed units the last several months, which I'm sure a lot of you have felt. Days on market on a month to month. This is the United States days on market. We ended the year at 26 days on market. And then here's Utah average days on market, overall 32. And then I'm assuming, Gordon, Utah's include the under contract period versus the United States. But we ended up at 55 days on market in December, 48 there in November. So let's talk mortgage rates. No doubt this has been one of the most compelling catalysts that has brought our industry into a little bit of chaos. No doubt that the government, the federal government, one of the most critical challenges that a federal government can face is inflation, right? And I know sometimes you can compare it to foreign governments with 80%, 100% inflation. So we still are blessed to be in the United States, but the rise of inflation, no doubt, was one of the biggest concerns that the Fed Reserve, the federal government could have. So they systematically started raising their Fed rate, which has really put the mortgage rates up the last 6 months. 2021, you can see, was 2.96 on average, but the last 30 years on average is right around that 6% interest rate when you take the whole 30 years into comparison. If you add another 20 years, when you think about those late 70s, early 80s, the last 50 years, we've actually averaged 7.81 mortgage rates to put it into comparison. But you can see here is the annual average. So 2022, we ended at 5.34% average mortgage rate over the year. No doubt the first half was still pretty low. They rose that last 6 months. We're still, a lot of the data still projecting potentially as high as 8% mortgage rates. They're going to continue to hold rates up until we see those inflation numbers go down, which I know a lot of you heard that inflation went from 7.1 down to 6.5 last month. We'll show you a lot of different versions of inflation, but I think we're trending no doubt in the right direction on curbing that inflation. Here's your monthly mortgage rates on a line graph. But yeah, just the last month or two, we kind of saw a little bit of a reprieve in mortgage rates, which has helped. Weekly interest rates. So this is comparing your 30-year fixed rate mortgage against the 15-year fixed rate mortgage. You know, traditionally those 15-year fixed rate mortgages are anywhere from 0.5 to 0.75%. But last month, basically, we averaged a 5.7% on the 15-year and then 6.4% on the 30-year fixed rate. So this is fascinating. I know the federal funds rate no doubt has you know, some weight into what mortgage rates do, but it's always not perfectly correlated. So this is an overlay of the Fed funds rate, which is the purple rate, which again, we ran almost 8 years at virtually 0% on that Fed funds rate, which was really a great environment to keep mortgage rates down. But you can kind of see, even look at the early 2000s, 2004, when they started raising it from 1 to 5%, look what mortgage rates did. It didn't consistently actually move them, but look at the gap early 2000s when it was at 1%, our rates were still hovering around 5-6%. But now you can kind of see it has followed the Fed funds rate trend a lot more than it did a decade and a half ago. So you can see as soon as they started raising that from 0 to 4%, again, we went from 3 to almost 7%, almost very systematically as they would raise rates on that. And here is also the other one. For some of you have been on our market report before, I told you we're going to continue to add more and more data as we find great, accurate sources. This is one that Gordon has added. This is mortgage-backed securities held outright by the Federal Reserve. So the Federal Reserve back in 2009 started purchasing those mortgage-backed securities. Even that was one of the ways that really kind of helped us prevent a full-blown depression as they start buying some of those mortgage-backed securities. But you could see the balance of the Fed funds rate. So these are kind of two of the major levels that the Federal Reserve has, is the Fed funds rate up and down. And then also, do they want to buy or sell off some of those mortgage-backed securities? You probably heard the term quantitative tightening, quantitative easing. So right now, at the end of December, basically the middle of December, the Federal Reserve still owns right now $2.6 trillion of mortgage-backed securities. And you can see in comparison to just what that Fed fund rates has done, as they've kind of almost stayed stable on the amount that they own, but the rate has been the primary lever that they have done. So Gordon, I know you pay attention to this quite a bit. Did you have any comments on this mortgage-backed securities held outright?
No, it's just them playing with the numbers to keep the interest rates down. And that's kind of damaged a lot of, we bought the buyers the last couple of years and push that forward.
Yeah. Well, and even in the 2020 time period, right? Like when they start dropping that Fed funds rate again to 0, the other mechanism they did to kind of keep the economy rolling was they bought almost $1.3 trillion of mortgage-backed securities, which is chump change, right, Gordon? Chump change, trillion. Yeah. So this is fantastic. This is the annual Mortgage Bankers Association, as MBA. So Mortgage Bankers Association Purchase Index includes all mortgage applications for the purchase of single-family homes. It covers the entire market, both conventional and government loans and all products. So obviously, we kind of consider mortgage applications taken as one of the predictors of what's going to happen on closed transactions in the real estate market. If someone's applying, obviously, for a loan, that probably means they have the intention of going out and buying a home. So the index basically is 100. So they kind of set that number back there in 1990. And then you can kind of see based off back then what has happened with that MBA purchase index. And then on the very bottom, you can kind of see just what interest rates on average were those years. So the index last year ended up at 224.6. But here's a line graph that shows more of a month-to-month story. So you can kind of see over 2022 as closed sales started to trend down late half of 2022, we already start seeing mortgage applications trend downward before that happened. Basically, the 6 months before that, we start seeing the mortgage application decrease, which then no doubt starts showing up in our under contracts and our closed units. But even look at the last couple months, we did see a little bit of a pop. I think we got down to about 160, 159 on that index. And then the last several months, we jumped up probably about 40 points on the mortgage applications coming in. And again, this is just purchases. This is not refinance. This is only the purchase of single family home index. This is another way of looking at it. Here's a mortgage credit availability index. Again, that 100 number is kind of your stable number. But we ended up at 113.7 of our mortgage credit availability. But let's look on a month-to-month basis. So here is pretty much the last 4 months, the teal or blue line. We're basically right at that 100 index, which was set March 2012, but 103, 102, 103, 103 mortgage credit availability. And here is kind of based on the mortgage credit availability index per loan product. So you got conventional, which that big giant drop right there was right around that chaotic 60-day period of COVID. Basically that February to April, who knew what was going to happen that 60-day period? You see the government MCAI, you see the conforming loan MCAI, and then jumbo also right around that same time period. Pretty drastic, felt like falling off a cliff a little bit on the mortgage credit availability. For the most part, a lot of people were just sitting on the sidelines, not knowing what to do. But here is a new one. Gordon finally found some accurate mortgage refinance index. So this is all based on refinance index. The yellow line, trend line, is your 30-year fixed rate mortgage. So you can kind of just see how the mortgage rates went from 3s to 6s pretty quickly. You could see what happened to the refinance index. It just felt like it stopped. I know we've got several mortgage professionals on here, but you went from every other loan you did being a refinance to almost zero overnight.
Hey, babe,
What's that? Thank you, Sue. But again, even as rates start trending down, as soon as we got, look, sub 4s on that, let alone trending towards the 2s, just felt like a rocket. I know our mortgage professionals were just drowning in applications and business right there. What a time to be alive, right? Here's our U.S. affordability. So let's talk about affordability, which I know is a challenge, So this is affordability. You can kind of see, we looked at this at Family Reunion last year. This is United States. We ended 2021 at that 16 number, but let's look at the index way they calculate it. So this is called U.S. affordability. It is the yearly housing affordability index. Higher HAI ratio indicates relatively more affordability. A ratio of 100 indicates that median family income is just sufficient to purchase the median price home. So if you're at 100 index, the higher above that, the more affordable a home is. You fall below that, trending even lower, that means it is drastically less affordable to buy a home. So 100 is kind of just sufficient income, median family household income to purchase that median price. So 2022, when we looked at this, again, this is one of those that has a little bit of a lag on tracking the data, but we were right around the 106 before the last several months of data. But you can see here now, the United States on a monthly ratio, we have officially fallen below that 100 index number across the country, which means it is not just sufficient to purchase that median price. So we are just coasting the last 6-7 months right around that 100 index. But again, if you look at early 2000s, before we really start seeing the price, skyrocket in those double-digit appreciation numbers, let alone before mortgage rates went up, we were at 188, 175, 183. Great time affordability wise to buy homes, but it no doubt has been challenging for the typical citizen of the United States to buy a home. But let's look at Utah. Again, because our prices went up about 25% more than the United States. We ended at 510,000 median price. And when you play the rates into it, we've actually been right at that 100 index of home affordability ratio. We've been at that 100 for the last 3 years, even before we saw the appreciation in those double digits. So officially in 2022, we ended the year at 73, about 27 below that 100 index line. But now look at the month to month. So basically before the first couple months of the year, we were still close to that line. But here is the story your buyers are trying to tell you in the 60s. No doubt this is unprecedented times of just some of the affordability challenges that we continue to have. So before we move on, anything else, Gordon, you want to throw into that section of our market report?
Nope.
Okay.
Other than we're going to have some really good deals coming on this year.
Yep. We're gonna, and that's why me and you, we believe we're gonna see some price depreciation. No doubt. Hopefully, we get inflation under control pretty fast, so maybe we can start getting those rates down. But yeah, absolutely, we'll start seeing some deals come on the market for our investors out there. So here's our investment.
Well, and also think about how many of those loans can be wrapped that are under 3%.
Mm-hmm.
I mean, that's the biggest story right there. If they really need to sell, that's a great way to buy something.
Yep, absolutely. The seller financing type transactions, you'll see a lot more of those pop up. So we're going to go over Utah average rental rates. We're going to show you a quick graph that they put together on rent versus owning, U.S. year-over-year rent growth, new build for rent, institutional buyers. And we'll talk about vacancy rates for a little bit. But here is basically year by year the average rental rate over these years. So you can kind of see, let's just look at 2021, Davis, Salt Lake, Utah County, and Weber County. So Salt Lake County 2021 was 1,301. And then 2022, Salt Lake County officially passed Utah County again, but 1,534 was the average rental rate right there in the middle of the summer of 2022. And then here is Salt Lake City average. So rental data is one of the challenging ones that we have to really make sure that we're finding accurate sources. So Salt Lake City does a good job at putting out their average rent on year end. So you can see 2022, Salt Lake City, a 4-bedroom average rent across the city was $2,460. A three bedroom average rental across Salt Lake City was $2,141. Even the studios, you can see, trickled up to 1,155. Gordon, studios where you just can lower that mattress, you can put it up, you can party, you can put the mattress down. Just kidding. 2023 fair market rent set by HUD. So HUD, again, HUD has several different federal housing assistance programs. And again, when they're starting to give out some of those checks in some of those low income scenarios for federal housing assistance, they have to kind of regulate specific markets on what they're willing to pay for rentals. So here you can see, let's even just look at Salt Lake County. This is 2023's market rent that they set for the federal housing assistance. So Salt Lake County, when you think about what we just went over, average rental rates, the 4 bedrooms, 2,308. 3 bedrooms, 2,061, 2 bedrooms, 1,504. So still a little slightly under. So I think the HUD is slightly under pacing, at least Salt Lake County and some of these other counties, on what the actual rental cost is.
And one interesting thing is they are using data that is several years old to come up with these numbers. They're not using current numbers from even 2021.
Yep, totally agree. Which again, Salt Lake, they always put above, but even last year, Utah County's average rental rates were higher than Salt Lake County, but drastically lower on the HUD set rent. So yep, often they're a little behind. Here's what they showed us at Family Reunion last year. If you remember, just the discrepancy again from renting versus owning. I know sometimes it's Take some courage for non-owner or homeowners to jump into the market and go buy something. But no matter how you track it, consistently, people that own homes versus renting constantly will have a higher net worth and a more equity or net worth in their life. So no doubt, no matter what the market's doing, encouraging and showing this type of data to our buyers that are on the fence that, you know, no matter what the time frame is, when you look at it long term, owning something is better than renting. I thought these were fascinating, Gordon. Thanks for putting these here, but these are your rent to income percentages. So you just think about the median rent compared to the income in these local marketplaces. 20% would be basically 20% of your income's going to rent. That dark blue is 50% of your income is going to pay that local rent number. So you see some of those light greens around the country, but look at the dark blues. I'm only seeing 2 of them, which is down there in California, Southern California. And then that right there is Utah County, which is crazy. So one of the highest rent to income percentages. Provo-Orem area 2022 ended at 43.7%. Salt Lake City, 36.4%. And then all the way up in Logan, you see, which still made that map, is 36.1% of their income goes to rent. Here's a great report this put out from some of the senators, but this is the Utah housing profile. I'm going to read a couple of things on here, but across Utah, there is a shortage of rental homes affordable and available to extremely low income households, ELI, whose incomes are at or below the poverty guidelines or 30% of their area median income. Many of these households are severely cost burdened, spending more than half of their income on housing. Severely cost burdened poor households are more likely than other renters to sacrifice other necessities like other healthy food and healthcare to pay the rent and to experience unstable housing situation like eviction. 21% of Utah households, or 61,000, they are considering they are extremely low income. The projections from this report was we have a current shortage of rental affordable homes available to those extremely low income renters. We're about 41,000 short, 41,000 short. I was appalled at that number on how many we actually are short. $46,136 annual household income needed to afford a 2-bedroom rental home at Hud's Fair Market. And then again, 70% of extremely low income renter households with severe cost burdens. So
well,
again,
and Johnny, if you also look at that, it's their income actually has to be higher in the current market than this because HUD is behind several years.
Totally agree. So you're going to see this continue to be a major piece of the conversation going on at the state and federal level. You're going to keep seeing proposals of how they're going to solve that, how they're going to try to throw money or pass some bills that's trying to do that. You're going to see special programs for builders and whatnot, trying to help solve that gap. But no doubt we're going to continue to see this unless we see prices go down and incomes go up. Here is your United States rent growth. This is year over year change, which basically means rent from December of 2022 was 4% higher than December of 2021. But that late 2021 and first part of 2022, you just see how fast rent was going. I remember when I had a couple vacancy turnovers and my property manager was recommending, you know, sometimes $100, $150 increases in the projected rent that we could get. But no doubt that has slowed. And in the United States, month over month, we've officially the last 4 months, Gordon and I were talking about this, we've started seeing some of that go backwards. So you're starting to see rent actually be lower than just slightly than it was last year in the United States. But again, Gordon, we're not seeing this data happen in Utah. We have not actually seen rent significantly go backwards yet.
Not at all.
Which again is probably because every challenge we have in the United States is compounded a little bit more in Utah. Everything's a little bit more expensive, and the inventory is a little worse in Utah compared to the United States. But here is the U.S. new build for rent. So basically, you're building something straight for rentals versus building it to sell. This is 2 or more units completed in the thousands, but you can see the 47-year average is right around that 3.65 number. And 2021 was basically the last 2 years, 2020 and 2021. This is a huge lag on the reporting of this. So this is looking a couple of years ago, but we were pretty close to where we're supposed to be, I guess. But you still look at how underbuilt we were on those new build for rent in the early 2010, 11, 12. And again, this is something they showed us family reunion, but Utah was one of the only Western states that was above the 15%. The amount of home purchases by institutional buyers in 2021, we had 16% of our home inventory that was purchased by those big institutional buyers, the capital groups, the hedge funds, which was pretty crazy. You see Texas right there was 28%. Super excited to see how we ended 2022. This is one that's only released every year, so I do think we'll see this at family reunion this year, but no doubt that's probably gone backwards. You've heard of a lot of those institutional buyers either just stopping or drastically slowing the rate or the percent that they're trying to buy, which that's been one of the major challenges that's compounded our inventories. You know, almost 1 of every 8 homes in 2021 in the state of Utah got purchased from an investment group versus going to someone that, that actually needed a household, a single family or a household. So here's the United States versus Utah. This is rental vacancy rates. It's so funny, Gordon, when I go to actually do a rental pro forma analysis or a rent projection kind of analysis, when I look to go buy a rental property, I got so used to putting 8% vacancy on my calculation. So when you're trying to project what your vacancy rate's going to be, and part of that is because, I was really getting my career started in those late 2000s, 2007, 8, 9, 10, where I learned that formula. So I've been overestimating for at least 5, 6 years, because you even look at 2021, Utah was at 4.4% rental vacancy. Even the entire country was at 6.1% in 2021. I bet even got a little bit worse in 2022, but hopefully we're going to start seeing rental vacancy go up a little bit more.
I'm really curious to see what 2022 numbers come in at. The data's not out yet.
Yeah. But again, that balance number is right at 7%. So even if we can get a little bit closer to that balance, 7% vacancy is kind of a fair number between investors and renters. But anything else on investment section, Gordon? Okay. So here is the U.S. economy. So we're going to go over these 5 categories, and then we'll hurry and look at the Utah categories. So we're going to look at GDP real quick, unemployment, real wages, income by sector, inflation. Inflation. So this is kind of what just the federal economy is doing. And a lot of these are the major drivers or major metrics that we track and look at to kind of know what is the 1,000-foot level going on with our economy. You start seeing a lot of challenges in the financial markets, crypto, all that before it even remotely started hitting real estate. But a lot of these numbers drive a lot of those sectors inside of the federal government. But here's GDP 2021. Well, you see 2020, no doubt that was COVID related. We just dropped a lot of the retail, restaurants, hospitality, they got really hit. Gross domestic product is basically the entire accumulation of all services and products that every business in the United States do in a year period of time. So 2020 went backwards. We sprung back up, let alone we had about 2% growth in 2021. This still is a projection, the annualized one, because quarter by quarter we have the data, but when they actually look and they bring all those numbers in, they're still projecting somewhere around that 0.2, could be as high as maybe 1, something like that. But we do have the annualized by quarter. So the first 2 quarters, no doubt, quarter 1 and quarter 2 of 2022, we went backwards, down 1.6 and down 0.6. We rebounded up 3.2 and 2.9.
And one thing to note on here, these numbers do get updated throughout the year. So I'll go and update these slides. So if you come next quarter and see some of these quarters have been adjusted, that's why.
Okay. And the real number they want to see on an annual basis is right around that 2% number, right, Gordon?
Yep, that's correct.
So here's U.S. unemployment. Again, when we hit those 2 quarters of negative GDP, traditionally that is the trigger to be defined as a recession, as 2 consecutive quarters in a row of backwards GDP. But the reason all the economists and reports were trying to say, hey, we're not really in a recession yet, even though that's usually how we define it, has typically been because of our still robust, workforce out there and the low unemployment rate. So we ended the year in the United States at 3.6% unemployed. And I typically say this, I remember sitting in my macroeconomics class at college where my professor said, we're always going to be somewhere around 4 or 5% naturally, because there's still going to be about 4 or 5% of able working bodies that just either choose not to or still be in between jobs or whatever, that are always going to have a baseline of about 5%. So the fact that when you get under that number, that means we're pretty dang low on our unemployment. But here's a month number. Again, COVID, it just felt like a rocket ship. It just a little chaos going on right there. But we went from 4.4 all the way up to 14.7. Basically, all those shopping, the hospitality, the restaurants, just, man, it was a really hard sectors to live in. I remember Gary Keller talking about one of his richest friends owned several hundred movie theaters around the country. And the second those lockdowns came out, it basically bankrupted him, which was crazy because that was just one of those industry sectors that just got hammered, where real estate, we survived it, let alone thrived through it pretty well. But here's US unemployment, and then comparing that US unemployment purple line to the published number of job openings, which again, this still seems crazy to me. But in November was the last month that we had reported numbers. They were declaring there's still 10.5 million job openings around the country. And we've been floating at that 10, 11 million quite a bit. And Gordon and I had this conversation just recently, again, mainly the tech companies. Almost every other day I'm hearing about tech company layoffs. And I get that those numbers are 10, 20, 50,000, which I guess maybe that is a dent in those job openings. But I am anticipating, no doubt, that number is going to start drastically going down. And here is 2 different ways of looking at it. So this is the real unemployment rate, which is called U6. U6 number includes underemployed, marginally attached, and discouraged workers, where the U3 basically counts those who have looked for a job in the 4 weeks. So U6 includes underemployed, part-time employees that just probably would prefer some more work. Marginally attached, I guess your guess is as good as mine on what that means. How do you like your job? Marginally. And then discouraged workers, the standard rate U3, which counts those looking for a job. Okay, so you see about a 3.3% difference in those U6 versus U3 unemployment ratios. And then here's the bar graph form. But you look at that 2020 number, early 2020, that U6 unemployment, we went up to 22.9. A lot of people got put on part-time even at that time period. Real wages. So real wages, we track income, like income going up or down, but real wages is basically what's happened with income. Because even the last couple of years, you've saw income go up. But when you actually take inflation, this is basically a combination of inflation and income numbers, which is called real wages year over year. So even though some incomes have gone up, no doubt across the board in the last couple of years, it hasn't felt like it, right? Even though some people got a pay raise, it's the eggs, it's chicken eggs, right? $6, $8 a dozen, whatever it is now, like it just doesn't feel like it because everything's more expensive, right? Which there you go. Here is our real average hourly earnings month over month. You saw the last couple of months, now that prices have started coming down in some categories, it felt a little bit like we've had a few months that real average hourly earnings have gone up, but clearly just almost the entire 2021, early 2022, every month with that inflation number going up, it felt like we were drastically going backwards on our spending capacity. Here's income by sector. So the last numbers we have on this is January 2022. So you can kind of see what income's been doing in those sectors. So you saw, financial activities, professional services, wholesale, construction, manufacturing, leisure, hospitality. But the yellow is year growth in 2020 and then year growth in 2021. And inflation. So let's talk inflation. This is really one of the things that Gordon loves to investigate into. And there's kind of a main way they track inflation, but there's a lot of other ways they track it that you might not hear about. This is something we saw at Family Reunion. So this is basically this time frame last year where inflation was at, what had happened with inflation. And this was kind of what the Fed was trying to project would happen if they took the measures that they were planning on taking, right? So we peaked at the CPI. So the main two categories is CPI, which includes energy and food, and then core CPI, which is a lower number. It excludes energy and food. So core CPI excludes food and energy because those two categories of CPI tend to be a little bit more volatile, so it can throw those numbers out of whack a little bit faster. But if you remove the craziness of energy and food, our core CPI had gone up to that 5.5%. But here's a couple different ways we look at it. And you might have to just come back to this when you download this PDF. PDF, but your CPI is your headline, right? This measures the monthly change in prices paid by US consumers. It does include the energy and food. Core the same way, which this isn't the one that usually makes the news, but this excludes the energy and food. But there's also two other categories, which is called flexible and sticky, that will show you that. Flexible is basically, it includes a few more goods and services categories that the change in price happens relatively frequently. And even the Atlanta Fed calls one sticky, which is basically includes a few categories that the price isn't as volatile. So it all just kind of depends on what things they're putting in to actually track how prices are going up or down. We'll also go up the food chain a little bit more. What we have a slide called the PPI, which is the Producers Price Index. This is a measure of wholesale inflation. So producers price is basically up that sales chain of kind of what's happening with prices at the wholesale price line. And then PCE is a measure of consumer spending, includes all goods and services bought by US households. And then PMI is basically an index that prevails economic trends in manufacturing. So more of the manufacturing index, and I'll show you misery index. So here's inflation. No doubt what the Fed's done is somewhat working. That core CPI or that CPI number, the yellow line, 9.1, 8.2, just like I said, from month November to December, we went from 7.1 to 6.5. So it's working. They started raising rates there in the middle of the year, right when we peaked, which was a really scary peak for them. But we're moving in the right direction. And if we stay on that trend, we could consistently every month see that inflation come down. But you can kind of see where that core, when you remove energy and food, that drop hasn't been as drastic. When you remove the volatility of energy and food, no doubt it hasn't moved as much. But then that target, again, the target of inflation, we know stuff's going to go up in price. We want to be at 2%. 2% is that healthy inflation number. This is something Gordon put together. This is dialing in to the different things that may or may not be included in some of those indexes. But all items they're saying has gone up 6.5%. You see food at home, like grocery store. I know I see posts at Costco and Target and Walmart. When you go shopping, it just feels like everything's more expensive. Food away from home actually has not gone up as much as the grocery store has, but overall combined, it is up 10%. Food, no doubt, is one of those major challenges we have. All energy actually is at 7.3%, but fuel, oil, 41%. Gas, because it went up, started coming down a little bit. This is December's numbers over the last 12 months. But natural gas, I didn't even know that was kind of creeping up, but we're up 33% of natural gas. Electricity, you see rent growth, owner's equivalent of rent, basically that home payment, all items less food and energy. But even look at that median home price, the real rent growth. But again, interest rates. If they actually put interest rates and the cost of a principal and interest payment into that CPI, the inflation numbers, I think that inflation number would be drastically worse, right, Gordon?
Well, and if you go back to that, if you look at what they're reporting, like owner's equivalent rent, 7.5%, but you look at the real numbers on median home payment, the Fed's so far behind what they're actually reporting.
The federal government doesn't lie, Gordon.
Yeah.
Just kidding. All right. Here's your flexible and sticky that I mentioned. Again, that flexible was some of those more volatile numbers. You could really see some of those different categories on how crazy it got in the early 2022 range. We have made a lot of progress on that. But again, that sticky one that the Atlanta Federal Reserve tracks is actually showing us that we have not made progress on that. Again, the producer price index, which again tracks a little bit more of that wholesale price range, up 6.2%. We peaked somewhere around that May 2022 number, but that's also came down. Here's the real personal consumption expenditure. This is basically like, are we going up or down on you guys buying stuff? And I remember Gary Keller about 6 months ago when I was in a meeting with him, he basically said inflation is basically a track. The only way we're going to really turn that around is you personally. How high does inflation have to go before you personally stop buying stuff? You know, you stop going on your vacations, you stop buying your new cars. And as soon as you start feeling like that's happening systematically, no doubt you're going to drastically see inflation stop. But again, when I'm on Facebook, I still see a lot of new cars, a lot of vacations, you know, and again, that K economy is happening. You know, the people that are really getting hit, they didn't have a lot of assets, like it is really negatively affecting them. People that have had a lot of great years the last 3 years, yes, prices are up, but it's not actually discouraging them from going on the Disneyland trip or buying that new car. So again, we're still seeing personal consumption expenditures up the last, you know, several quarters in a row.
Basically, well, the thing that's deceiving about that also, goods have started to come down, but experiences have quadrupled.
Yeah, totally agree. Totally agree. Here's your market-based personal consumption expenditures, excluding food and energy right there, Q4 up 3.8%. And then here, again, we haven't learned our lesson as a country. This is revolving consumer debt. This is seasonally adjusted, but right now we're at all-time highs in the history of the United States at personal revolving consumer debt. We're at $1.18 trillion of consumer debt. So I know it's really old-fashioned advice, but save your money, then buy it. Don't buy it and figure out how to pay for it, right? The only caveat that Gordon and I talked about is this doesn't necessarily take in the United States population to it as well. So sometimes if we had quick spikes in population, that could have affected the revolving consumer debt per household. And then here's your annual personal savings rate of disposable income. So basically your income minus your fixed expenses, that piece that's left over of disposable that you shop, you vacation, you spend on whatever, what percent of that are you saving? Again, right after COVID happened, everybody started panicking and they immediately start socking cash away, let alone the COVID lockdown just forced us to stop buying stuff and traveling because of all the mandates that were going on. So you see why that just skyrocketed. But again, we're back down, which even last month was a little bit of progress, but we've got to get that average, the annual personal savings rate of disposable income up. We need to be saving more of our money. And here's even another kind of projector of what may or may not happen, but this is manufactured durable goods, new orders in the millions right there. So 287 billion of manufactured durable good orders. And then the ISM, here's basically the purchasing managers index, PMI, new orders, officially fell below that index of 50. Which means anything above that is expansion of purchasing managers index. Anything below that is shrinking. So we're at 48.4%. And even advanced retail sales. So this is the retailer buying things clear in advance, but still positive year-over-year increases. And then here's just how we're feeling. I don't exactly know how they get this data, but it's basically survey after survey of the US index of consumer sentiment. Higher number, the better we feel and the more likely or positive outlook we have on the economy. The lower is no doubt clearly a more pessimistic approach. You can see we actually got to the bottom somewhere around July-ish. They were worried about the economy. We've trickled up a little bit to right around that 60 number, but clearly 100 is a really great number for us to return to. And then here's another index we track that Gordon found a long time ago, but the misery index. This is basically the misery or the index of misery. This basically combines unemployment rates with inflation rates. So clearly a lower number, the less miserable people are, is better. But you could see even after COVID, even though inflation wasn't necessarily cruising up at that point, but because unemployment went so up so fast, That was the highest track that we have at 15.03. But you can even see that misery index has consistently came down the last 6 months, which is a positive sign. Here's the month over month. But then inflation. So roll your clocks back to 1989. The average car in 1989 was $15,350. But adjusted for inflation, the actual inflation, that car in today's dollars was actually $36,298. So if car prices just floated with inflation, that car would be worth $36,000. But in reality, comparing that to real auto prices right now, $48,281, the real change from prices from 1989 to 2022, cars are up 33.01%. Totally can feel that. You see gas. Gas adjusted for inflation is actually up 43% more expensive than it was in 1989 in real dollars. Houses 65%. No doubt the appreciation has outpaced inflation, but that's the crazy thing is mortgage. The average mortgage, because rates are consistently lower than even they were back then, a mortgage is still 5.5% more affordable than it was in 1989. This is a really, really good graph to kind of bring perspective into the market. And then wages, no doubt, the average wage was $9.80 on average. Every profession out there, adjusted for inflation, 23. Right now it's 28. So our incomes are up 21%, which goes a little bit farther on the mortgage, but not necessarily on gas, the house price, and cars. Okay, and then we're hurrying to look at the Utah economy. Again, Utah, we are the youngest median age in the country. Congratulations, you young people. We are still the best baby makers, the largest household size, 2.99 in the state of Utah. We have the lowest unemployment rate, the 4th highest median income, the 2nd lowest poverty rate. Utah continually hits great scoreboards, and we are officially voted the #1 sexiest state in the country. Thank you, everybody. Here is Utah job change by history, by industry. You can kind of see where some of that job expansion is going. Financial activities have actually shrunk the last year, 3.4%. Non-farm employment, you could see Utah versus United States kind of pace each other pretty well. But here's our Utah unemployment. So last year we ended up at 2.1. That purple line is comparing the United States. So again, we continually have lower unemployment. And here's month by month, 2.2 is where we ended last month in Utah, 2.2 compared to 3.5 in the country, which again, it's hard to fill all of our open positions. Here is the latest data we had on that, but this is basically quarterly GDP growth, 10.8% there in Utah. And then here's real GDP, $187 billion of GDP, all the service and products in the state of Utah, really great, robust economy. And you can see year over year, just great years of growth in the state of Utah. And then here's personal income. So United States is purple, Utah is orange. We've actually had a little bit better growth of income compared to the country the last several years. And then let's hit construction real quick. So this is U.S. single family home starts, residential housing starts, new single family, and then builder confidence. Again, United States, on a million average homes built a year, we're 14 years below that million. Again, if you add up those numbers, 5, 6, 7 million. Here's a good overlay of building permits, which is the yellow, and then units, actual housing starts in the state of Utah.
And this is one of my favorite slides. I know Johnny doesn't like it, but you can kind of see the direction here in Utah where we kind of split out the single family homes and now the entry level home is a condo.
Yeah, totally. Year over year residential housing starts by year. So you saw builder permits in 2021, 20,000 were pulled, 40,000 units started. And we don't have 2022's data yet, but here's even just the value in billions, 8.8 billion started in 2021. And then here is the price index of new single family houses under construction, with that 100 being up there, clearly just the price index of 182 last year. And then multifamily residential construction. price index up there, almost double that index number, which again, that started in 2005. But here's a really great one. I like to show this, but this is Builder Confidence Index. This is basically, you can tell just the confidence of builders to build homes really peaked right there at the end of 2020. You saw a lot of gasoline being thrown on those builder machines, just cranking out as many homes as they could affordably. But we're down pretty low. We're as low as basically that builder index was when COVID hit. Which, you know, the only time we've been lower than that is, you know, the recession, early recession timeframe when builders just kind of just stopped. And I think a lot of builders are basically just kind of putting pause. I know most builders are not buying a lot of land right now. They're kind of just kicking the can down the road because they just want to see what happens the next 60, 90, 120 days before they turn their machines back on. And then year over year in that index change, we ended the year, which again, primarily just that last 6 months dropped us, but we went backwards 37%. So, all right. Gordon, any other comments on builder stuff?
Nope, that's it.
Well, thank you, all of you 147 participants that were here, record on our market report. Again, I invite you every quarter to jump on. Gordon will be posting this again on kwutah.com. He did record this. He'll be posting that as well in case you want to go back. I know we flew through a lot of data right there at the end. I have been tracking the market quarterly for the last easily decade of my career. It has meant a lot to me in the decisions I make, the scripts, you know, the choices I make in my business. So again, if there's ever a time to be on this and continually pay attention, it is now. So thank you, Gordon, for updating this. We'll get this out. Any other comments, Gordon? You're on mute. Gordon, you're muted. Gordon. Rookie. All right. Well, thank you, everybody. Thanks for being on the call. You guys are rock stars. Have a great weekend, and we'll chat with you next week.